What's up everyone, welcome to this video. Today is FOMC day, the Federal Reserve telling us what their decision is going to be regarding the interest rates. The market is expecting the rates to be unchanged, but it's going to look forward to the guidance and the dot plots that the Fed is going to give us. But earlier this week, the market was shaken by Deepseek. Deepseek, a company, a Chinese company, developing an AI, a competition to the American AI companies for a fraction of the price and a fraction of the compute. Really creating a lot of doubt in the market as to whether the investment in AI in the US, the massive investment that has been done, is going to be something that's going to bring the returns that the market expects. So let's have a look here at this article. We see CNN stating why DeepSeek could mark a turning point for Silicon Valley on AI. And of course, the worry is going to be on NVIDIA. NVIDIA, of course, the biggest GPU manufacturer in the world, a company that has seen a tremendous increase in its stock price. And over the last few days, the last couple of days, since Monday, the share stock has been dumping. So let's have a look here. CNN says the wake-up call came from in the form of Deepseek, a year-old Chinese startup whose free open-source AI model R1 is more or less on par with advanced model of American tech giants. So let's have a look here. We're gonna go to Twitter and we're gonna look here at this benchmark, and you can see the blue one, dark blue, is DeepSeek R1, and the gray one is OpenAI O1. And as you can see, DeepSeek is basically on par with the latest model of OpenAI, but it has done so at a fraction of the cost. Now, of course, nobody is sure as to whether what DeepSeek is stating is true or not. They claimed to have only spent $6 million on compute to be able to bring this model, which a lot of people are going to doubt. People are saying, of course, that there is a lot more money that is being put by DeepSeek, and they are not stating the true numbers. But regardless of whether that's true or not, it has created absolute chaos in the market. So as you can see here, the share price of NVIDIA falling down from 150 to 120. We can see here from the top, we saw up to 23% dump on the NVIDIA stock price, and we're talking about a $3 trillion company as of today, a market wipeout, a market cap wipeout of $500 billion, the biggest wipeout in the SP 500 ever. And so with this background, now we are going to take to the Federal Reserve and the Open Market Committee to see what their decision on interest rate is going to be, knowing that by itself, this huge drop in NVIDIA stock and the SP 500 is a tightening of financial conditions. So let's have a look.
4.25% to 4.5% is unchanged. The central bankers say again that, quote, considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As they've said before, risks to the inflation and employment goals are roughly in balance. The committee continues QT, reducing the balance sheet at current levels, and does not mention any endpoint. And while 4 new members joined the rotation this year, Collins, Goolsbee, Musalam, and Schmid, The decision was unanimous. The rather anodyne statement puts the focus on Chair Jay Powell, who will be speaking to us in about half an hour. Other than acknowledging inflation hasn't made progress, there isn't much in here that will lead you to speculate on what they'll do next.
Mike, just stay right there. Just want to share the price action with you, then follow up with the question on the labour market. So equities have backed off just a touch, not a whole lot, but just a little bit more. We're down 0.6% on the S&P. Yields have kicked higher as well by a couple of extra basis points. At the front end by 5, on a 10-year now up by 4. The line on the labour market, Mike, it feels like they've buried the scare of the summer, and that they're now satisfied, almost comfortable, that unemployment can stabilise at these levels. And Mike, I'd wonder what you'd say about that.
At this point, it doesn't look like they're thinking that the labor market is going to rapidly decompose. There are some signs that things are getting a little bit slower. We're not seeing people get jobs as fast as they did before. But right now, unemployment is still low, and it moved down in the last month. So as long as that's the case, they're going to call it solid and not particularly worry about it. A real deterioration might lead them to cut, but they're not seeing that now.
Bob Michael says it's the best position this Fed's been in 20 years. Do you agree?
No. That's an easy answer, but this is a very hard situation for the Fed because they can't be preemptive, they can't forecast it, because they've got to wait for policy and react to it, and then they've got to figure out. The one scenario that's not in there is a stagflationary scenario, which I don't think we get to unless we have a really big policy mistake until 26, 27, and one would hope that we'd see a course correction before then. But that is one of the scenarios you have to put into this equation.
And Professor Clarida. Professor, I'm going to go to you on this.
Yes, sir.
This afternoon, maybe more important than the economics, is Microsoft and Facebook with a combined $110 billion of free cash flow in the last 24 months. We have a part of America absolutely booming, technology, productivity, you know the drill. And we got another part of the country, as Craig Torres writes about for Bloomberg, flat on their back. How does Powell handle that with this new president, this bipolar America?
Well, I think it's been an emerging fact of life in the U.S. economy for decades. You know, the numbers I like to look at are, 2/3 of Americans own their own home. That means 1/3 don't. More than half of Americans own stocks. I mean, the other half don't. So if you own your house, you have stocks, you've had a really good run. If you don't, it seems like a very, very tough time. And so the Fed can only really impact aggregate employment and output, and so I don't think there's a lot the Fed can do about it, but it creates a challenge in terms of navigating sentiment, for sure.
Squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong, is strong overall, and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.6% over the 12 months ending in December, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews. Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. I would note that the committee's 2% longer-run inflation goal will be retained and will not be a focus of the review. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-run inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve.
Mr. Chairman, Steve Leisman from CNBC. Mr. Chairman, at a event in Davos, or from to Davos anyway, the president said he'll demand that interest rates drop immediately. So I guess I have a 3-part question. Has the president done this to you? Has he made that demand? Secondly, what is your response to that? And third, what effect, if anything, if any, does a president making these kind of remarks have on policy? Thank you.
3 questions. I'm seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, and that's how we best serve the public.
Can you just comment on whether he's physically communicated his demand to you?
I've had no contact.
Thank you.
Thanks.
Colby Smith with the New York Times. Chair Powell, how should we interpret the removal of the line from the statement that inflation has made progress towards the 2% goal? Is that no longer the case?
No. So let me look. If you just look at the first paragraph, we did a little bit of language cleanup there. We took out a reference to since earlier in the year as it related to the labor market. And we just chose to shorten that sentence. Again, I mean, if you look at the sort of intermeeting data, it was good, and there was another inflation reading, I guess, just before the December meeting. So we've got two good readings in a row that are consistent with 2% inflation. Again, we're not going to overinterpret too good or too bad readings, but this was not meant to send a signal. Other than this, you can take away from all of this that we remain committed to achieving our 2% inflation goal sustainably.
And just to follow up, we've seen inflation expectations across a number of measures rise sharply, which has in part been linked to tariff concerns. But there's also been this encouraging data that you mentioned in terms of CPI and rent indices. So how would you characterize concerns about upside risks to inflation across the committee, especially those tied to policies related to the Trump administration?
Well, I'd say you see expectations moving up a little bit at the short end, but not at the longer end, where it really matters. And those could be related to what you mentioned, some of the new policies. I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We're only just beginning to see, and actually are not really beginning to see much. And I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So we're going to be watching carefully, and as we always do. This is no different than any other set of policy changes at the beginning of an administration. We'll patiently watch and understand, and kind of not be in a hurry to get to a place of understanding what our policy response should be until we see how it plays out.
Howard Schneider with Reuters. Thank you very much. In 2021 at a central bank conference, you said, quote, throughout my career in both public and private sectors, I've seen that the best and most successful organizations are often the ones that have a strong and persistent commitment to diversity and inclusion. These organizations consistently attract the best talent by investing in and retaining a world-class workforce. First question is, do you still believe that? And if so, how do you intend to put that belief into practice while remaining consistent with the recent executive order prohibiting diversity and inclusion efforts?
So let me say yes, in answer to your first question. But to the second question, I want to say this. We are, like others, we're reviewing the orders and the associated details as they're made available. And as has been our practice over many administrations, we are working to align our policies with the executive orders as appropriate and consistent with applicable law. And I want to add that I'm not going to have anything more specific for you today on this whole set of issues.
Well, if I could just follow up quickly on that, I'm wondering how you're getting that to be consistent with the Dodd-Frank law's stipulations about maintaining an Office of Minority and Women's Inclusion.
So I did mention consistent with applicable law. All right.
Follow up on Steve's question. What reassurance can you give the American public that the Fed will continue to operate independent of politics under this administration?
As I've said countless times over the years, this is who we are. This is what we do. We study the data. We analyze how it will affect the outlook and the balance of risks, and we use our tools to try to, given our best understanding, our best thinking, try to achieve our goals. That's what we do. That's always what we do. Don't look for us to do anything else. And that's, lots of research shows that's the best way for a central bank to operate. That'll give us the best possible chance to achieve these goals for the benefit of the American people. That's always what we're going to do, and people should have confidence in that, as I said a few minutes ago.
Last month you talked about a future rate cut as being pretty, significantly predicated on more progress in inflation. With the characterization of the labor market in the statement today, would you say that that's even more so the case now?
I'd say it's the same. We want to see, further progress on inflation. And, the story's there. we're just going to have to see the data. At the end of the day, it comes down to 12-month inflation because that takes out the seasonality issues that may exist. And, we're just going to need to see that. We think we see the pathway for that to happen. One example, a key example, is that you now do see owner's equivalent rent and housing services, the way it's calculated for PCE. You see that coming down pretty steadily now, and that's the place where most of the remaining gap is. In addition, a big part of the overrun, as you will know, was from non-market services, which don't tend to send much signal. So you can look through all that and think, okay, then we seem to be set up for further progress.
All right, and that's it. That's enough of this press conference from Jerome Powell. As you can see here at the end, he mentioned the owner's equivalent rent going down. And of course, this is probably something that he expects. We're going to see that come down really hard. And then the CPI is going to follow. And then we're going to realize, oh, we've been in recession all along. But we'll see how that develops. But for this press conference, basically, Jerome Powell being tight-lipped and not really answering questions, keeping to his shtick and saying, oh, we want to do, both of our mandates, stable prices and high employment. And really, the Fed decision not to move rates is sort of similar to the Jerome Powell conference, not wanting to actually answer the questions. And as he was saying, they're wait and see mode, and they don't want to take any action. And perhaps this is the problem with the Fed. They are like a zombie walking into a trap, and they're not going to react until it is too late. And the reason for that is they are using lagging indicators. They are using lagging data like the CPI. And instead of looking forward toward where this economy is going, they're going to wait until we see a crash, a recession, until they lower rates. And it is very funny to hear him saying, oh, well, we are totally independent. We would never be political, when he decided to cut rates in September, just before the election, to try to push Kamala Harris and the Democrats, past the line. And then when he failed and it was confirmed that Donald Trump had won this election, then, oh, well, we're not going to cut rates anymore now that our guy is not in. And really, it's quite laughable that, they are pretending not to be political when every single decision that they take is utterly political. And, this question by, I think it was the Bloomberg guy, asking him, did you have any contact with the president when he was talking at Davos at the WEF summit, that he wanted rates to calm down? And Jerome Powell said no. And, who knows if that is the truth or not. But anyway, the Fed not moving at all towards rates. And, as we've been saying in this video, I think sometime in the future, we're going to look back at this whole period and we're going to realize that the Fed was behind the curve like it has been expected for a while, and that indeed it will be their mistake that will provoke the recession. And when that happens, of course, they will have one guy to blame, Donald Trump, who's in the White House, who's going to be the perfect scapegoat, and they will achieve their goal. They were not able to put a Democrat in the presidency, but for sure they will be able to crash the economy under Donald Trump's watch, and then they'll be able to blame him and to say, you should have voted differently. But anyway, thank you for watching this video. Don't forget to subscribe to the channel, leave a like, and I will see you all on the next one. Peace.
Hit me with that like, and sub to the channel. Hit me with that like, and click the effing bell. Click that bit, alright. The algo recommends, for she gon' like. The algo knows you well. Hit me with that like, subscribe to the channel. Hit me with that like, and click the effing bell.